want to start by asking you that, the issue is fully offer for sale. How should an investor look at this? Because a lot of private equity and early investors are now exiting from the company.
Yeah. So first of all, the private equity investors that are selling, they're not selling all of it. They're actually selling approximately 30% of their holding because of their own liquidity reasons, etc. But more importantly, about the company itself, broadly, the numbers work out like this. For every additional dollar of revenue that we do, we need approximately maybe $0.15 to $0.2 of capex and about $0.2 of working capital. Okay, so for every additional dollar I make for growth, okay, about 0.35 to 0.4 of investment needs to come in. Okay, where will this come from? Okay, so that leads to the question of our profitability. If our profitability is strong, then this can be fueled just by the internal accruals. Okay, that's the story of the company. Today we are running at about 20% EBITDAs as displayed in the RHP. And that is more than sufficient for us to propel a growth of about 30-40% without needing any money at all. And further, our debt to equity ratio is very favorable. If you want a little bit more money for even additional growth more than 30-40%, debt is available. Over and above that, I mean, if you're growing at more than 100%, etc., we will take equity, but we don't think that we are in a position where we need to take equity for the next 3-4 years. So there is no need for the company to raise capital now, and that's the reason we have not done it. So it's a purely offer for sale.
All right. So your RHP says that there's heavy dependence of revenue from TVS Motor, particularly one company. So how are you seeing this risk of concentration of clients, and how do you plan to increase your client base, and what is actually the client base between India and overseas segments right now and going forward?
So first of all, customer concentration is a risk for any business. Okay, so if you have customer concentration, the reason is actually quite simple. First is that if your customer itself starts doing badly, then you're also pulled down. Second reason, which is I think what worries investors more, is that okay, if the customer is doing well, but your relationship with the customer goes bad, okay, or the customer has other options, then you are at risk, your numbers are at risk. So these are obvious risks related to customer concentration. But in every situation, it's important to understand the specifics of the situation. So if you ask the question, why is it that TVS has, we have heavy dependence on TVS at this point in time? The main answer is that the key technology that we have built, sensorless commutation as applied to in 2 and 3-wheelers, both ICE and EV, that technology is a first in the world. And we have carried to the market where TVS has been the anchor adopter of the technology. Okay. So when you have an anchor adopter, you will have heavy dependence in the early journey of that technology propagating, and that's the reason why our numbers show that. Okay, and if you looked at a little bit more carefully, like where we were in FY25 versus 9-month FY26 that we have shown in the RHP, you can see a trend, a bit of a dropping trend. That's reflective of other customers coming in. We have also mentioned in the RHP that Bajaj Auto is now a significant customer. Okay, so it's a very natural process that when you first introduce technology, you have anchor customers, and it is a case of mutual dependence. They respect us, we respect them, and it's a case of mutual dependence, and that's the reason why it's seen like that. The other question that you asked about what is our mix across geographies, the main selling that we do outside of India is not in the 2 and 3-wheeler space. It is in the generator space and the e-bike space. E-bike is a close cousin of the 2-wheeler space, but generator is a very different story. So our customers outside of India, okay, are heavily generator manufacturers in the US, or there are tier ones who are operating in the e-bike market in Europe. So that's our mix. In India, it is the 2 and 3-wheeler manufacturer and also all the generator manufacturers. So we have about 10 to 12 significant customers, and like any B2B heavy technology business, you go to the big adopters to say that, hey, this is a new technology, why don't you adopt it? That's been our journey. So we have about 10, 12 big customers, and of course, TVS concentration is there. Right?
All right. Yeah. So you would say that Indian concentration is more than the overseas right now?
Absolutely.
And going forward, how do you see this?
It will continue to be the case. Our bread and butter market right now is the 2-3-wheeler market. And that is not going to go away because we have lots of things to do in the 2-3-wheeler market. And we do expect that because of that, in our revenue mix, the 2-3-wheeler OEMs, whether it is Indian or whether it is Japanese or something, they will have a significant portion. Okay, and the other portion will be generators. But generator market is a lot smaller by itself than the 2-3-wheeler market. So even if we have very good presence there, on our overall numbers, the generator contributors will be lesser. But now we are going after, like if we have mentioned the RSP, other markets, like we are going after power tools, we are going after CVs, etc. So over a period of time, we believe that the big players there will also start occupying. Okay, and how much we sell to whom depends on the relative size of the market and all the strengths of our propositions there.
Got it. So as of now, it's India and overseas. Talking about overseas, with US trade deal, tariffs, what sort of risks do you see with the whole, your clients over there? And also marginal supply is taken care of from China. So if you could talk about the whole geopolitical risk to your business.
Yeah. So the tariff, we do sell parts to the US. We export parts to the US. So the tariff situation is applicable to us. First of all, I think it should be clear that the tariff is not paid by us. It is paid by the importers. That is, our customers pay the tariff to the US government.
Okay, all right. So you heard the management. Of course, the IPO opens tomorrow for subscription, and the details, of course, were flashing on your screen right there.